Silicon Valley Bank, a technician's tale. I'm going to show you what I'm inferring as went down with Silicon Valley Bank using the charts, and I'm going to show you the charts that I'm going to keep an eye on to help follow the story, okay? So the deal is that this Silicon Valley Bank, which until last week was part of the S&P 500, this bank was, as you might imagine, a real lifeline to Silicon Valley companies, okay? Most of their depositors, people who stored money there, were large tech companies. Now, when they gave them these funds over the past few years, remember, most of that time we were in a low interest rate environment, okay? The Fed hadn't hiked rates yet, and so the money that was sitting in those banks, which could then be lent out to earn interest, well, that interest they could earn on those lend outs was not that exciting. So Silicon Valley Bank was like, we're going to put this in the safest investment in the world, the US bond market. So what they did was they went and they said, all right, we're in this suppressed interest rate environment where the yields are staying low, and we're going to go ahead and put money into these bonds because the value of the bond should rise and it should be a good investment. The thing is, it was all about the timetable. And let me show you what I mean. When they invested in those 10-year bonds, they started losing money when interest rates started going up, right? Because yields and the bonds, in this case the futures, they have an inverse relationship, an opposite relationship. So not only did SIVB have their investments so tied up in one type of security, which deteriorated in value, all their depositors were of one type, right? Tech companies in Silicon Valley, startups, etc. But even if they're companies with a lot of cash, they didn't account for the fact that when the tech company might hurt, so let's look at the tech company via the XLK, that when the tech industry might go through rough times and those companies might actually need the cash they kept at the bank, they'd show up and ask for it. So from there was this gap where there was a demand from the depositors to get their money, but SVB hadn't gotten back its value in the 10-year. And if it sold its 10-year bonds now, it would be at a much poorer price than what it bought it for. Real problem, they needed liquidity to then meet the demands of the depositors, and that's when everything started going really south. So what am I going to keep tabs on to help me stay on top of the SIVB story and what else might be going on with regional banks and more? Well, I have two of the tickers that I'm going to start with here, and the rest I'm going to dive into in a session I'm doing with my tribe. It's anyone in the HEMA Ready tribe this coming Wednesday, March 15th at 4:30 p.m. Eastern. So if you want to invite to that, just look at the links below this video, check out your email, and if you still can't find it, then reach out to us at support@hemaready.com. So the two tickers I'm going to look at are the same market, but they're just the opposites, okay? So you've got the 10-year. So the 10-year bond, which is the one that we've got this surge lately in, but it looks like it might be tapping out soon. And specifically, there are price spikes. That's a tool I teach in 4 Zones RSI that might be suggesting that there's some resistance overhead. Now, the flip side of that is the actual yield on the bond, right? So it's the 10-year yield CBOE index that I follow here, $TNX.X in TradeStation, and you can see that that has come to a support area, which matches the resistance that the bond itself is coming to. So I'm going to keep a close eye on this. I'm also going to look at other parts of the yield curve, and again, I'll dig into that more in my live session. I'm having a bonus from an entire tribe coming up later this week. But I really want you to take away two important lessons here, okay? First is that what SIVB did had a risk story to it, right? They had all their depositors coming from one industry, the tech industry, which has had its volatility over the past several years. They put all of their eggs, many of their eggs, their deposited dollars into a market that then didn't unfold the way they expected because of changes in interest rate policy. And the other is the timeline between when they thought they'd get back their investment, their profit on buying the 10-year versus what happened with the essential run on funds by depositors. A bank has to meet the instant request of the depositors. It can't go and wait for its investment to make a profit first. Again, though, we're in a situation here where the Fed has come in and essentially said, hey, SIVB, we're going to come in and we're going to kind of honor your original pricing at which you bought the 10-year, even though it's tanked since then. And that is kind of helping keep things afloat. The company is also, the bank is also now at auction as of me making this video. So a buyer could come in and help kind of pad things and support the market because, again, the banking sector here, XLF, is likely to continue to be beat up by this type of activity, right? And people's concerns over the security of their funds and more, not just in Silicon Valley Bank, but in other regional banks and more. So it's a very interesting story unfolding. Keep an eye on it. I am sharing my interpretation of what's going on and what I'm going to keep tabs on to stay on top of it, because this could just be sort of one of the little hints on the outside of things that could be coming. So this could be an early sign, and we want to make sure we don't miss the others. So keep an eye on these two charts. So here in TradeStation, it's $TNX.X for the actual 10-year yield, and it's at symbol TY for the continuous contract of the 10-year bond. Okay, bond and yield are opposites. As long as you know that, you're going to be good if you want to analyze these and are watching for when they may pause or change direction. Catch you on the inside.